Hello everyone. We left off with our narration of PowerPoint slides for Chapter 11 with Schedule D. This is where all of our capital gains and losses are reported using the Form 8949 and Schedule D. So this is going to just kind of illustrate how that's set up. On the 8949, Part 1 is for short-term, Part 2 is long-term. So you just list the assets sold and the information that needed to calculate the gain or loss. All right, we tell them whether it's reported. 1099B is a statement you get from your broker if you have that for your investments. Just a couple little quirks. They ask you to put the cost basis, including commissions, that sort of thing. Which is exactly how it's reported on almost all 1099Bs for you. So that's not really an issue, but it does go against what the typical idea of that we talked about last time in Chapter 10, that you subtract from the realized amount. Add them all up. Part 2, which is on the back if you're using the form as you get it off the internet, you put your long term. They net together, transfer over to the actual Schedule D, Part 1. Short terms at the top and carryovers entered. Netted together, short-term capital gains into losses. And then the long term goes into this bottom part. Capital gain distributions. And the carryovers are shown in line 14. This is where you net the long term against the gains against the losses. And this is where you net together, okay, long and short term goes to the back. Okay, line 16, which is page 2 of the Schedule D. And this is where you calculate the tax by breaking out the amount that we showed you earlier, the amount for capital gains versus the amount of ordinary income, and apply the tax rates. If it's a loss, this is where you show that you're going to use $3,000 this year, and then the rest is going to carry forward the following years. All right, some, you might say, oddball parts of calculating gains and losses, or capital gains and losses. It's talking about stock. There's always a possibility that a company will go completely bankrupt, out of business, before you even have a chance to sell the stock, and it becomes worthless. So we treat that as if it was sold for zero in the year that we become aware that it is worthless. If it was always that simple, it wouldn't be a big deal, but sometimes it's a little hard to determine whether a company is worthless. Typically something really bad has happened, and often that gets covered up for a little while before you realize that, and everybody gets the news. So, but the basic idea is fairly straightforward. Deemed as sold, you get the capital loss. Section 1244, remember there was Section 1202 stock, which had some ability to exclude gain if it had fit certain criteria. This is on the loss side. Very similar situation, but in this case, the amount of the loss can be much bigger and it can be ordinary. And it's for those who own stock in a small business. So they could have a loss as much as $100,000, married filing jointly. And to qualify, this is very narrow. This is not buying stock in IBM or something. This is where the corporation's total capital, all that the stockholders invested, was $1 million. Sounds a lot, but it's not. That's a small business. and it has to be operating. It cannot be an investment company. You can't have these losses by everybody putting money in and buying stock in someplace else. It has to operate, have employees, machinery, that kind of thing. All right. Capital assets, they could be ordinary if there is between related parties. We're not going to spend a lot of time with that. Gains on subdivided property. Buy a piece of land and then you break it into lots in order to sell it. Okay? You have to be an investor and not a dealer in the property. So as you're a dealer, it's inventory, and therefore it can't be capital. But if you are a investor, meaning you only sell a few lots, then it could say capital gain. And this is the criteria. Okay, notice that 5 years, can't make improvements to the lots. Only that which is necessary to get them sold. And then 6th year, the 6th lot is sold, we recognize capital gain up till then. And then the income is only up to 5% of the sales price. So essentially, you're going to get capital gain on this scenario for all your lots. Example, sold, subdivides the land, sells 3 lots for $10,000. So our gain in each lot is $7,500 because our basis is $2,500. Okay, that'll all be capital gain up to the year that she sells a 5th lot. So when she goes over that in 2018, then she has some potential to have ordinary income. But in this case, selling expenses were $1,800. Okay, and the gain that is ordinary is only up to 5%. So 5% of the $40,000 she sold them for total is $2,000. $1,800 of the selling expenses goes against that. She only ends up with $200 as ordinary income. So in essence, it's all capital gain even after that 6th lot is sold. So basically, subdivided real estate, if you are not a dealer, is a capital gain, a capital asset and capital gain. And that was 5 years you had to hold it too, so you have to remember that. Where other capital gains come from, a non-business bad debt is a short-term capital loss, reported on the Schedule D, just like any other capital loss. You basically couldn't collect money from someone you made a legitimate loan to, not to generate business, but just because. Now, it can't be just you gave money to Bob and he doesn't pay you back. There's got to be a loan document. There's got to be interest charged. It's got to be legit loan, not just somebody reneging on a IOU or something like that. And then personal casualties are capital gains and losses. All right, Section 1231, property. This is where all of your assets that are used in the business. Remember, we said earlier, those are not capital assets. They are Section 1231 assets. Now, tax law provides a kind of a special deal on these types as long as you own them for a year. Notice it has to be held long-term. Gains can be treated as long-term capital gains, and losses are deducted as ordinary losses. All right? This is all reported on Form 4797. There's a separate podcast, a little bit about how that 4797 plays out. All right? So this seems like the best of all possible worlds. You get gains, you get the lower tax rate on. Losses are not limited to the $3,000. Wow, cool. Okay, so of course there are lots of exceptions. But first, how would that play out if these were your gains and losses? You would net them all together and you'd find out that that was $3,800 and it would be treated as an ordinary loss, which means you could deduct all of it, not just the $3,000. Okay, exception number one, problem with these Section 1231 gains if it's depreciable property. All right, so we're talking about anything other than real estate, anything that you have depreciation on. To the extent of your depreciation, you have to recapture it as ordinary income. So there goes a big benefit for Section 1231 because the amount that you have to recapture for depreciation. So let's see how this would work out. Doesn't apply to real estate after 1986. Sold a machine for $24,000, purchased for $60,000. We've taken $42,000. So his basis now is $18,000. All right. So when we realize and recognize the gain, we take how much we sold it for minus the $18,000. We get $6,000. We go, hey, this is a Section 1231 piece of property. It's used in a business. So we should be able to use the capital gain rates on this. But for the depreciation recapture, no, no, no. As long as your gain is not more than the $42,000 depreciation that's been recognized over the lifetime, then it is ordinary income. So the $6,000 is ordinary income, not capital gains like we might think. Okay, so there's your exception to our kind of best of both worlds scenario. Second problem with Section 1231 gains, second way that they are limited, you might say, and that is you have to look back over the past 5 years. Anytime you have a long-term capital, a Section 1231 gain, you have to look back and see if you have any losses from the last 5 years. To the extent you do, they are ordinary income. Okay, so you look back. Joey has $14,000 of net gain. He has some losses in past years that he took as ordinary losses. So when he reports his gain this year, he's going to use up to $4,600, I think, in the last 5 years as ordinary income. The rest would be Section 1231 or long-term capital gain. So it's not completely gone, but it really takes a chunk out of it. All right, so little different scenario, and this is Section 1250 gain. This applies to real estate. Okay, we're looking again at the amount of depreciation. Your Section 1250 gain is up to the amount of depreciation on your real estate. Okay, it only applies to sold at a gain. Doesn't matter if it's a loss. So we apply the gains. We always apply that gains or losses first to the 25%. Any remaining 1231 gain is taxed at the rates we've seen earlier, the lower capital gains rates. Sample. This is the best way to see this. Real property, $520. Sold it for $520, purchased it for $500 at the time of the sale, with $45,000 been taken on the property. So our gain is $65,000, right? All right, so, but that gain is $45,000 of Section 1250 recapture. All right, first, the rest of it, the amount over what we originally paid for it, is a actual capital gain, Section 1231 capital gain, all right, at the lower tax rates. I mean, 25% is still lower, but it's not as low as it could be. Okay? So a little bit more about netting, capital gains and losses. Always apply to the most expensive ones first. So we apply the long-term loss here against the 25% first, then the rest goes against the short-term. And so this person would end up with $400 short-term gain, which of course would be at the ordinary tax rates because it's not long-term. And then a second example where we go the other way. We first apply the 25%, the losses. We get down to 8,900, and then we have a gain in both these columns, and we're done with 8,900 at 25% rate and 8,400 at the capital gains rates. So that's how those all net together and play out for our capital gains. So that will finish chapter 11.